Before we dive into the impacts of World War III on your finances, don't forget to subscribe to our channel for more insightful content. Now imagine waking up to a world at war. How would that affect your money? Historically, the specter of war has cast long shadows over financial markets, triggering periods of extreme volatility. This is a reflection of investor uncertainty and fear. When nations go to war, stock indices can plummet drastically in a short span of time, sparking widespread panic in the market. Picture this: investors, fearing the worst, start offloading their stocks en masse. This results in significant sell-offs and potentially massive losses for those who aren't prepared to weather such turbulence. The fluctuating prices of financial assets during these times mirror the anxiety and lack of confidence of economic players in the face of a global conflict. But it isn't just stocks that bear the brunt. The bond market too feels the tremors. As the drumbeats of war grow louder, investors often seek refuge in what are considered safe assets, government bonds and commodities like gold. This flight to safety causes a surge in demand for these assets, pushing their prices up and consequently driving interest rates down. This leads us to an interesting phenomenon: the inversion of the yield curve, where long-term rates fall below short-term rates. This inversion is a classic sign of economic slowdown and uncertainty in financial markets during times of war. It's a barometer of sorts, indicating that investors see the future as being highly uncertain and are therefore choosing to park their money in assets they perceive to be less risky. War also has a profound impact on the price of oil and, by extension, the financial market. Political instability in oil-producing regions can disrupt production and exports, causing prices to skyrocket globally. This rise in oil prices directly affects various sectors of the economy, leading to higher production costs, increased final product prices, and inflationary pressure. In the face of war, financial markets can become a tumultuous sea of uncertainty. But by understanding these historical trends, investors can equip themselves to navigate these choppy waters with a greater degree of confidence and foresight. In a world at war, where does money find refuge? During times of conflict, money often seeks safety in the form of stable assets, primarily government bonds and gold. These assets provide a sense of security that volatile markets cannot offer. Let's delve a little deeper into this phenomenon. As the financial markets become increasingly unpredictable, investors tend to shift their capital into these safe havens. This sudden surge in demand for government bonds and gold causes their prices to rise. When bond prices increase, their yields, or the interest rates they offer, fall. This is due to the inverse relationship between bond prices and their yields. Now, when we talk about interest rates, it's important to understand the concept of the yield curve. In normal circumstances, long-term bonds offer higher yields than short-term bonds, reflecting the risks associated with time. This causes the yield curve to slope upward. However, during times of conflict, this curve often inverts. This means that short-term interest rates exceed long-term rates. Why does this happen? Well, the inversion of the yield curve is a classic sign of economic slowdown and uncertainty. Investors, fearing an unstable future, prefer to park their money in long-term, less risky bonds, pushing their yields down. This inversion of the yield curve is a clear signal of the anxiety and lack of confidence that investors experience during wartime. Similarly, gold, with its reputation for maintaining value even during economic downturns, becomes a highly sought-after asset. Its price tends to rise as investors flock to it, seeking a safe store of value amidst the chaos. So in essence, during times of war, the financial landscape undergoes dramatic shifts. Investors scramble for safety, causing a surge in demand for stable assets like government bonds and gold. This leads to rising bond prices, falling interest rates, and an inverted yield curve, all of which are stark indicators of the economic uncertainty that war brings. In times of war, the search for safety can lead to dramatic shifts in the financial landscape. War and oil, a volatile mix. But how does it affect your finances? Consider this. The global stage of a possible Third World War would no doubt have significant impacts on oil prices. Oil, an essential commodity that powers our world, is primarily produced in regions that are often at the epicenter of geopolitical conflicts. With war comes political instability, which can lead to interruptions in oil production and exports. This disruption in supply can cause oil prices to skyrocket, and these price shocks can reverberate across the entire financial market. But how does this affect you? Let's break it down. Oil is a fundamental input in many sectors of the economy. When its price rises, production costs increase across a wide range of industries. This uptick in costs is typically passed on to the consumer in the form of higher prices for goods and services. In other words, your everyday purchases could become more expensive. It's not just about higher prices at the pump or the grocery store. This surge can also lead to an inflationary pressure. Inflation, as we know, erodes the purchasing power of money, meaning your dollars could buy less over time. For investors, this could mean reduced real returns on investments. Furthermore, companies that are directly linked to the oil sector may face operational and logistical challenges in the face of the chaos caused by a large-scale armed conflict. This could negatively impact their financial results, affecting the value of your investments in these companies. In a world at war, the price of oil becomes more than just a figure at the gas station. It becomes a key indicator of financial instability. Therefore, it is crucial for investors and financial analysts to closely monitor the evolution of oil prices and geopolitical news. This vigilance can help you anticipate possible opportunities and risks arising from this complex and volatile scenario. In a world at war, the price of oil can become a key indicator of financial instability. In a world at war, does the dollar become king? This is a question that has surfaced time and again during periods of geopolitical instability. The simple answer is yes. The dollar often appreciates in value against other currencies during such times. But why does this happen, and what are its implications? To understand this, we need to acknowledge the role of the dollar as the world's reserve currency. This title bestows upon it a sense of security and reliability. In times of war or global uncertainty, investors and governments alike seek refuge in the American currency. This rush towards the dollar is what causes its value to appreciate. However, this strengthening of the dollar isn't just a simple game of numbers. It can have wide-ranging impacts on international financial markets, affecting everything from international trade to the cost of financing for companies and governments. Let's delve a bit deeper into this. In terms of trade, a stronger dollar can make imported goods and services cheaper for Americans. However, it can also make American goods and services more expensive for foreign consumers, potentially hurting American exporters. The cost of financing can also be affected. For countries and companies that have taken out loans denominated in dollars, a stronger dollar increases the real burden of their debt. This can lead to increased financial strain, especially for emerging markets with large amounts of dollar-denominated debt. Moreover, the strengthening dollar can also cause a chain reaction in global currency markets. As the dollar strengthens, other currencies may weaken in response, causing economic instability in those countries. This can further exacerbate global economic uncertainty, leading to more volatility in financial markets. So, while the strengthening dollar might seem like a beacon of stability in a turbulent world, it's a double-edged sword with far-reaching consequences. In times of crisis, the dollar's strength can send ripples through the global financial pond. Therefore, it's crucial for investors to closely monitor the evolution of the dollar during times of geopolitical instability. In times of crisis, the dollar's strength can send ripples through the global financial pond. Gold, the ultimate safe haven. But what role does it play in a world at war? Let's dive into the glittering depths of this precious metal's significance during times of global conflict. Gold holds a unique position in the financial world. It's not a bond, it's not a stock, and it doesn't pay interest or dividends. Yet its value is universally recognized, and it has endured as a symbol of wealth and stability for thousands of years. When the world's financial markets are shaken by war, investors often turn to gold as a safe haven. Why is gold such a draw during times of conflict? Well, it's all about perception. Gold is seen as a stable store of value, particularly in times of economic uncertainty. It's a tangible asset that you can hold in your hand, and its value doesn't depend on a government's promise or a company's performance. This makes gold a popular choice for investors looking to protect their wealth when the financial landscape becomes rocky. During times of war, the price of gold often rises. This is due to increased demand as investors flock to the perceived safety of this precious metal. The more uncertain the world becomes, the more attractive gold seems. And in a global conflict like a potential Third World War, this effect could be magnified. But it's not just individual investors who see the allure of gold in troubled times. Central banks around the world also hold gold reserves as a form of financial insurance. In times of crisis, these reserves can provide a source of liquidity and a buffer against financial shocks. However, as with any investment, it's important to remember that the price of gold can fluctuate. While it has traditionally performed well during times of conflict, there are no guarantees. As always, a balanced and diversified investment approach is key. In a world at war, gold can shine brighter than ever for those seeking financial safety. It's a beacon of stability amid the storm, a tangible asset that carries the weight of centuries of trust. And in the unpredictable world of finance, that kind of reliability is pure gold. In the face of war and financial uncertainty, how should you, as an investor, respond? Let's navigate these turbulent waters together. As we've seen, war can have far-reaching effects on the global economy and financial markets. It can influence oil prices, strengthen the dollar, and boost the appeal of safe haven assets such as gold. But what does this mean for you? Firstly, it's important to understand that investing during times of war requires careful thought and planning. The market volatility that can accompany global conflict can be a source of both risk and opportunity. It's essential to stay informed, keep a close eye on the markets, and be prepared to adjust your investment strategy as necessary. Diversification, as always, is key. Spreading your investments across a range of asset classes can help to mitigate risk and potentially improve returns. This could involve a mix of stocks, bonds, commodities such as oil and gold, and potentially even cash. It's also worth considering the potential benefits of investing in defensive stocks. These are companies that provide essential services such as utilities or consumer staples, and their performance tends to be less affected by economic downturns. But perhaps the most important thing to remember is not to panic. The financial markets have weathered many storms over the years, and while wars can cause significant short-term disruption, history shows us that markets do recover over time. It's important to take a long-term view and not make hasty decisions based on short-term market movements. And finally, don't be afraid to seek advice. A financial advisor can provide valuable guidance and help you navigate the complexities of investing during a time of war. Remember, knowledge is power, and it's your most valuable asset when investing in uncertain times. If you found this video helpful, please like, comment, and share it with your friends. Don't forget to hit the bell icon for notifications on our latest videos. Thanks for watching.